Good afternoon, everyone. Fittingly, the last of these presentations on a Friday afternoon is with the OG, the original, the world's first collective investment scheme. The year that Disraeli lost the general election to William Gladstone was the year that investors first subscribed for shares in what was then foreign and colonial investment. Oh no, Paul will be able to correct me. That was not the name when it launched, but I'll leave him to do that in a moment. And then listed on the London Stock Exchange in 1879, I believe. And as you'll see in Paul's presentation, there's plenty of long-term perspective about the 21st century to talk about as well. So before I hand over to Paul, just a quick bit of housekeeping. You'll see in the bottom right-hand corner that there's an option for you to ask questions. Please do type in any questions you have. Other participants can't see those. Don't be shy. If you have any technical issues, then you can put a message in the same box. Paul's going to talk for about 20 to 30 minutes, and then we'll get into questions. And so with that, I'll hand over to Paul.
Okay, great, and thank you very much for joining this afternoon. Alan, do you want to bring up the slides, and perhaps we can just start with some key facts for the trust, which some of which you've touched on already. So I think a notable point. I won't dwell on the history. I'll give a little bit of a history lesson already, but we are the world's oldest investment trust, longest surviving collective investment scheme in the world, serving retail shareholders for over 150 years, really set up back in 1868 to provide the investor of moderate means access to the same opportunities as large capitalists of the day. So essentially democratizing investment over 150 years ago. We've had consistency in a number of levels, consistency in terms of portfolio management. I am the third manager since 1969 and only 11th in the last 150 years. We've paid a dividend every single year since launch back in 1868, and we have paid 54 consecutive rises in dividends. So we've got a long history of consistency, and I'll talk about what we delivered in performance terms as well as we go through. A lot of experience clearly as well, making investments in equities since the 1920s and private markets since the 1940s. And in recent decades focused very much on growth assets. So that is listed equity and private equity. And I'll give you a sense by the portfolio composition in a few moments. We also have scale. So remember the FTSE 100 index happened for several years now. Our market capitalization is around £5.8 billion, total assets 6.6. And we also have very attractively priced long-term fixed interest debt, which is really important actually in terms of one of the advantages clearly of being a closed-ended investment trust is that we can borrow to invest. We took out £580 million worth of borrowing at very competitive interest rates. So the blended rate on that debt, and it is fixed, I should say, repeat the point, 2.4%. So if you were, UK government and going out to borrow in the market today, 10-year rates are about 4.5%. If you're a corporate, you'd be paying a credit spread on top of that. So I think comparable interest rates for us would be closer to 6% than the 2.4% that we actually pay today. So we locked in very, very attractive rates of debt at a very fortuitous time. And in fact, we borrowed out to 2061 at a rate of 1.87% fixed. So we're very pleased to have secured that long-term fixed rate debt. And we think we offer value for money, and that's obviously a focus of the board. And again, one of the advantages of the closed-ended structure is that the board are working on behalf of shareholders and obviously keep us as a management company, and I work for Columbia Threadneedle Investments, keep us on our toes in investment terms and in commercial terms. So 45 basis points, 0.45% ongoing charges, which we think is very competitively priced. If you want to move to the next slide, please, Alan. I'll just give a brief comment on the approach that we have and what we're looking to deliver. So the overarching aim of F&C is to deliver long-term growth in both capital and income. So I explained already, we've got a very long history of paying dividends for shareholders. We're not a high yield trust where we're yielding something like 1.3% or thereabouts today, but we have a progressive dividend policy and have grown dividends for 54 consecutive years. The approach that we undertake in terms of seeking to deliver on that overarching objective is investment in listed and unlisted global growth assets. That is listed equity and private equity. We blend active strategies to achieve the benefits of diversification. I think that's particularly relevant now, given concentration in market, and we do have a commitment to net zero by 2050 or earlier. And the outcome that we look to deliver for shareholders is consistency. Consistency in terms of performance delivery and also value for money. Next slide, please, Alan. So this just outlines some of the benefits that we see in our diversified approach. Now, there is I think a tendency, a trend in terms of global equity products to offer focused strategies, and we believe actually that focused strategies in terms of stock count have a clear role to play. But we do think it's very important to blend focused strategies together in a manner that adds returns while reducing risk. Diversification is often said is the only free lunch in investments, and a diversified global equity portfolio that we offer has several benefits. First, there's been a lot of coverage given to an observation that's technically called skew in markets. What that is actually only a small number of stocks, only a very small number of stocks drive all of market returns in the long run. And that is true in the US and non-US markets. If one looks in the long run, it's only a very small number of stocks that actually deliver the majority, the very significant majority of overall returns. In fact, it's about 4% of those stocks which deliver virtually all returns in the long run. And in fact, the majority of stocks either underperform cash or short-dated government bonds, or they lose value in absolute terms. Now, what you do with that observation? Well, clearly, if we had perfect foresight, you would just buy that small number of stocks that deliver all of the long-term returns. But unfortunately, none of us, as hard as we try, have perfect foresight, and therefore diversification actually provides a better chance of including the small number of outsized winners. And we think that by blending together focused strategies that use specialist managers, either investing globally or regionally in listed and unlisted markets, will increase the chances of having exposure to the outsized winners, but also removing or reducing the exposure to the outsized losers, those stocks which don't add value through time. So blending those strategies which are focused with a clear objective regionally and globally should add return, reduce risk, reduce volatility, also reduces the risk of timing mistakes. What do I mean by that? Well, certain themes, trends, markets come and go with respect to popularity, valuation, excess, and there's a tendency to essentially overestimate prospective returns in certain instances. So again, dot-com bubble, Japanese bubble, examples of that. And in 2020, similarly, we saw really concentrated performance based on the view that the world was going to fundamentally change in terms of the way that people and investors behaved. So by diversifying across a range of different areas, you reduce overexposure to areas of the market that are perhaps overpriced and don't offer attractive long-term returns. So it's really important, I think, to include the winners, but also to reduce the sizable number of losers in the market. Diversification through this focused approach enables us to do so. The final point I make on this really is that our view is that there's more than one way to win in global markets. So in the long run, we do know that if you buy cheap stocks, i.e. you buy value, if you buy high quality stocks, i.e. companies that have got a moat, as Warren Buffett would say, around their business and have got a well-protected business model, and if you buy momentum and growth, those styles of investing yield a positive return against the market in the long run. The challenge is that obviously the performance is highly variable through time, and there can be long periods where value doesn't work as a strategy, and indeed growth doesn't work as a strategy, or quality doesn't work as a strategy. But nonetheless, if you buy cheap stocks with good growth prospects and a strong moat around their business, high quality businesses with strong momentum in fundamentals and in price terms, then you tend to deliver excess returns against the market in the long run. So by spending risk efficiently on those stylistic characteristics, which we know tend to constitute a large part of returns or excess returns in the long run, we think that we increase the chances of delivering excess returns against the wider market. So focus on rewarded risks, and we pay a lot of time and attention in terms of thinking about portfolio construction and ensuring we've got the right composition for shareholders. A couple of final points before we move on to some of the more practical aspects. We use internal and external resources. So I work for Columbia Threadneedle Investments. We're obviously appointed by the board to run the portfolio, and we're a global asset manager. So we're an asset manager with more than $500 billion of assets under management globally, with experience in listed and unlisted securities. But we can also invest in strategies from across the markets. We're not beholden just to what we have access to internally. We can choose from across the market in terms of private equity and listed market equity, listed market exposure as well. And that enables us to blend attractive strategies at an attractive price for shareholders. If we want to move on, please, Alan, to the next slide. So what does this mean in practical terms? We seek to deliver a one-stop shop for both listed equity exposure and private equity. And what this shows you is the geographic regional exposure and the global exposure that we have. That's the outer part of the pie in the left-hand side there. So we've got exposure to the US, and the inner part of the pie shows the strategies that we have. I've not gone into the detail here. I'm sure many of you have heard me speak before, but we have within the US, for example, 2 value strategies, one run by Columbia Threadneedle, one run by Barrow Hanley, who are a Dallas-based value manager that we have a mandate with. We've had a mandate with them for over 20 years, actually. And then JP Morgan Asset Management run a growth strategy for us in the US as well. Europe, we've got a single strategy there. Emerging markets, that's run by Invesco, actually. We granted them a mandate earlier this year, so they run the emerging market strategy for us. Japan, run by Columbia Threadneedle. We've got 3 global strategies, including an income strategy, and then we've got various components within private equity that, if I have time, I'll touch on as well. The right-hand side shows you top 10 listed holdings. Now, there's a lot of familiar names, as you would expect there. Magnificent Seven, represented through NVIDIA, Microsoft, Apple, and others. But the point here is we end up with relatively diversified number of stocks in terms of names in the listed portfolio and the unlisted portfolio, but we are looking to provide exposure to strategies in the US, different regions and globally, which are providing something different and complementary to each other. So again, this principle of adding return while reducing risk is integral in terms of the way that we approach selection and combination of components in the portfolio. If we move on to the next slide, please, Alan. This shows you in a bit more detail, and there's a lot of detail here. I won't dwell too much on it, but it shows you how much we have with JP Morgan, how much we've got with Barrow Hanley, and then the other components. And it gives you a sense about how these strategies are investing. So JP Morgan, as I said, investing with a growth lens, so very much focusing on companies that are expected to deliver high rates of growth in terms of fundamental earnings delivery, attractive growth opportunities, whereas the Barrow Hanley exposure is in terms of stocks that are priced below the market average, typically providing a higher dividend yield, but also offering a relatively attractive growth profile as well. So this shows you the proportion of the portfolio in each of these strategies, how many holdings each of these strategies have, how many of those holdings are unique on the portfolio, and also what the active share is. Now, active share is something that some people like to look at in terms of measuring the activeness of a manager. It's not as effective actually as some other metrics like tracking error, but it is nonetheless worth considering in terms of thinking about the activeness of the manager and the strategy that they have. Active share typically far lower in concentrated markets, a UK market, or indeed a global growth or US growth index will typically have a low active share simply as a function of the concentration of that index that the manager is running it against. We've got 10 to 11% in private equity. We target between 5 and 15% in private equity, and we invest through both funds, unlisted funds. So this is not liquid exposure; it's unlisted fund exposure, as well as co-investments. And co-investments give us exposure to very specific company opportunities. And I work very closely with my colleagues in Columbia Threadneedle, where they select and bring me essentially deals to consider from within the predominantly the mid-market space in the US and Europe primarily, in both fund and co-investment terms. And then in Pantheon, we've got a bespoke mandate where we use Pantheon, a well-known private equity manager, to source and select for us through a bespoke mandate leading venture and growth managers that otherwise we and our shareholders would not otherwise be able to gain access to. If we move on to the next slide, please. Again, I won't dwell on this slide too long. This just gives you a sense about how we've moved the portfolio around. Lots of information on here. I've shown you the last 5 calendar year ends in terms of how much is in US growth, how much is in US value, how much is in Europe, and so on, and where we stood at the end of October. Periodically, we've made some pretty big calls between growth and value. We're relatively balanced right now. We're actually slightly long of growth against value in the US. It's not represented on this chart here, but we have been raising exposure to emerging markets, a point that I'll come on to as we go through. But we manage these components actively in terms of determining what the appropriate percentage allocation to each area is, and periodically we will change the underlying components. So again, the market mandate for move on to the next slide, please. Next slide. Move on to the next again, please. So the outcome, in terms of response here, the outcome that we've been delivering. I'm looking for a graph. Hopefully,
Paul, your connection just glitched for about 30 seconds. So do you just want to rewind your sentences a couple of paragraphs?
Okay. I do apologise. If you can move on to the next slide. I was basically asking you to move on to the next slide.
Yeah.
There we go. Right. So apologies. The wonders of modern technology. Okay. So this is the outcome that we look to deliver. Excess returns. This shows a long-term lens. There's a 20-year window here showing the performance that we have delivered as a trust against the global equity index and against UK equities. And I should have said closer to the outset that we're global. So a decision was made before my time, actually, at the beginning of 2013, to invest in a purely global basis. So we don't have a domestic bias. That decision to pivot away from UK to global was very well timed. It's been accretive in terms of shareholder returns, and we're very proud and pleased with what we've delivered for shareholders over the long term. So this gives you a sense about what we have delivered over the last 20 years or so. The next slide, Alan, if you can pull it up. Shows you the compounded returns over 1, 3, 5, 10, 20 years in NAV terms and in share price total return terms, and then how we've done against the peer group. So the point here, in general terms, we're first or second quartile against our peers in NAV and shareholder return terms. So again, this point about consistency is really, really important. At the end of 2024, we were very pleased to have beaten both the benchmark and the peers in over 1, 3, 5, 10, 20 years in NAV terms. As I stand today, I think I'm right in saying that we are the best performing global trust in NAV terms over the last 3 and 5 years. Again, I'm pleased with that. Record of returns, which I think is really important. And just make a few comments about where we...
Paul, your connection's just glitching slightly again. Just give it a second to catch up.
Okay. Next slide, please.
Yeah.
So just a few minutes on global growth, inflation, earnings outlook, and what that means in terms of markets from our perspective. And I think there will be some questions, I'm sure, just about where we are in terms of the market cycle. Views on technology stocks, valuations, and so on. But this picture here shows you consensus GDP forecasts and how they've changed through the year. Essentially, a few points I'd make. One, the US has proven to be far more robust, actually, in growth terms, and I think most people had assumed after Liberation Day. On the right-hand side, you can see the blue line there showing a collapse in GDP growth expectations for 2025. Essentially, that reflected pessimism after President Trump had announced the initial proposed tariffs, which obviously were moving from an average tariff rate of about 2.5% to around 25% proposed. Expectations were that this would be really detrimental to the growth outlook in the US. Subsequently, actually, the picture has been far better in terms of what has been delivered in growth in the US than had been feared. And you can see that in the right-hand chart with the upward revisions that have taken place in terms of the growth picture on the US. And there's a couple of reasons for that. Obviously, there was some reining back in terms of the proposed tariffs and the levels. And as we stand today, we're looking at average tariff rates probably closer to 15% than 20%, and the implemented tariffs thus far are closer to 10 than 15. So we're still to see the full impact of the proposed tariffs, and there's been some reining back in terms of the levels that were proposed. Inflation has been stickier, I think, fair to say, than had been hoped. And obviously that bears through in terms of central bank policy, which I'll come into a few moments. In terms of looking into 2026, the picture looks pretty stable, actually. If you look at the expected growth outturn in the US, Europe, and elsewhere, the gap between the US and Europe is generally expected to narrow slightly. So a somewhat better outcome is expected. And that's also reflected in terms of what we can see in terms of the earnings picture. And I'll ask you to move on to the next slide, and I'll just touch on this point briefly. So again, lots of information on this slide. I'm going to draw out a few key points. We've got the S&P, that is the US Bellwether Index, expected earnings growth for 2025. We're obviously quite far through that. And you can see how this is changing and has changed through the year. What you can see is the Magnificent Seven, that small cohort of stocks, disruptive tech stocks that really led the market. Expectations for Q4, and also, what the 493, the rest of the market are going to deliver. So let me just draw a couple of numbers. Looking at 2025, the Magnificent Seven are expected to deliver 25% expected earnings growth. The rest of the market is likely to have delivered about 7.5%. So there's quite a big gap between that small cohort of exceptional stocks delivering very high levels of growth and the rest of the market. Looking into 2026, that is expected to narrow. So there's a moderation in terms of expected growth rates from the Magnificent Seven in terms of EPS outcomes, where there's been, traditionally very positive surprises, but there's expected to be some moderation in growth and some convergence with the rest of the market. So broadening earnings growth. And that picture is also reflected globally. The right-hand chart shows you, again, quite a lot of information here. The solid bar is the latest expectation for 2025. The grey dot shows you what had been expected at the beginning of the year, and the orange dot shows you what's expected for 2026. So a couple of points here. One, the US is expected to deliver pretty much what was assumed would be forthcoming at the beginning of the year in 2025. And 2026 is expected to be a very similar year in terms of earnings outcome to that which we saw in 2025. So no major surprises actually at the index level for the US against what was expected at the beginning of the year, albeit the picture, as is shown on the left, it's been the Magnificent Seven that have really been driving those earnings surprises, and the rest of the market is doing well, but is disappointed against those initial expectations. Europe, by contrast, was expected to have a pretty respectable outcome in terms of earnings this year in the high single digits, and that's the grey dot there in the right-hand chart. But actually, it's going to show modest reduction in earnings this year. So there's been quite material downgrades and disappointment to European earnings this year. But looking into 2026, quite a significant upturn in earnings expected in Europe. And part of that's about this fiscal expenditure and the impact of that fiscal expenditure in terms of the broader earnings outcome. Japan's a similar but less pronounced picture to Europe, as is the UK, as is emerging markets. But Europe was really the big area of disappointment in terms of earnings outcome this year, but a big bounce back expected. And actually, we do have increasing confidence that the picture for Europe is brightening. Our internal analysts are far more optimistic on Europe looking into 2026 than they have been at any point really in recent calendar years. So a better outlook fundamentally, we think, for Europe looking into 2026. Can we move on to the next slide, please, Alan? So this slide just looks at inflation and interest rates. A couple of key points here. One, rates have been coming down. They've been coming down in Europe for rate cuts this year. They've been coming down in by the Bank of England, 3 rate cuts, and the Fed's cut twice, and there's more expected. There's another 3 or 4 rate cuts expected from the US Federal Reserve looking into 2026. And inflation is tracked broadly sideways, but it's coming down. It's stickier, as I said, than had been hoped, but we don't think will be preventing further easing, which is expected by the markets looking out over the next 12 months. The ECB is really the only area where we're not expecting rate cuts over the course of the next 12 months. If we move on to the next slide, please, Alan. So what does that mean? Well, firstly, no recession, we think. We're not complacent. We do retain vigilance in terms of interpretation of data, and recessionary outcome clearly would be bad news for equities. This shows you how markets, equity markets, the US has performed around easing cycles. And what I mean by that, there's been 11 periods where since 1970 where the Fed have cut rates, and more often than not, actually, it's been around a period of recession. When you get rate cuts, the average outcome for equity markets, shown by the orange line, is that they trend upwards over the following 12 months and 24 months. If there's a recession, then equity markets tend to lose value despite the rate cuts. The best environment for equities in that scenario is rate cuts and no recession. And that is the environment that we think we're in right now. And the dotted blue line there shows you the performance of markets in this rate cutting cycle. So into the rate cut and subsequently. And the performance with higher volatility, clearly, but around, around type, they're tracking kind of average levels of performance in a rate cutting cycle where there is no recession. And we don't think we're looking at recession. And actually, the second 12-month period tends historically to be better than the first. So fundamentally, we think the picture is reasonably good. I'm going to make a few more points before we move on to questions. So if we move on to the next slide, please. We are constructive on the US. We have become far more constructive on emerging markets. A few reasons, and there is a valuation debate on US assets in general and equities, specifically. The US is a premium market, trading at a premium valuation, as I'll show you in a moment, but it has delivered premium growth. And we expect, as I showed you in prior slides, it will continue to deliver premium growth. The margin is going to diminish. We do expect a broadening within the US market and regionally as well, which we actually have seen in recent quarters in general terms. But we do retain a relatively optimistic view with respect to the US outlook. And we're more optimistic on emerging markets. Why? We came into this rate cutting cycle with very attractive valuations, we think, in emerging market equities. It is, and there'll be differing views on this, a play in part on technology. If you look at the proportion of the emerging market indices which are invested in tech stocks, it is relatively high and secondly only behind the US. If one looks at it from a regional standpoint, rate cuts tend to be good for the emerging market complex, and the weak dollar, and we've also seen dollar weakness in general, that is also positive for emerging markets. So we think we've moved quite a long way in valuation terms, but there's more to go for on the EM complex. So we're quite constructive there. And actually, as I said, a better environment for Europe, we think, looking into 2026. So we have not made a move there as yet. Can we move on to the next slide, please, Alan? I'll make just a few more comments and then open to questions. There's been a big upturn in CapEx, again, a point of discussion. The Magnificent Seven are spending a lot more of their free cash flow on CapEx. It's expected that we're going to get £450 billion per annum from the Magnificent Seven and others in coming years spent on essentially build out of AI infrastructure, data centers, and so on. And we are beginning to see companies tap credit markets to fund some of that expenditure. Up until now, these have been capital light businesses, and they have not been tapping credit markets particularly to fund growth. But that is changing, and that's something that will require a close eye in terms of their spending plans. In addition, next slide, please. AI is having big impact on the workforce. Again, a point of debate, but it's quite noteworthy that the Magnificent Seven have begun to flatline in terms of their the workforce. They are not adding workers. They are tending to pivot towards technology within those organizations to drive greater efficiency. So not adding to their workforce. And again, a point of discussion as to the wider implications of AI on the workforce through time. And then finally, before we open to Q&A, valuations. Next slide, please, Alan. This shows you what I think you probably know. Valuations are quite rich in equities. Forward multiples on equities are high compared to history. But I think it's quite interesting that everyone looks at the Magnificent Seven, and I know there's a tremendous dispersion of what the businesses within that complex actually do. But if you look at the premium of that cohort of stocks, bottom right, against the rest of the market in the US, it's not obvious that we're trading at extended levels against the wider market. The whole market's trading pretty rich, it's fair to say. But we think that valuations are justified, provided that the current growth expectations can be met, which is obviously a big caveat. But nonetheless, we do think that valuations are rich, but not yet at levels that will restrict further progress in equities in quarters ahead. So I'm going to stop there, probably run a few minutes over. Quite a few questions I think are coming in, so I'm going to pass back to you, Alan, and hopefully we can run through some of the points which are of particular interest to you.
Yeah, there's an interesting question that came up early, and I think part of the answer is that FCIT is an equity investor, be that public or private, but there's a question about a changing world and whether there are other asset classes like crypto, and I suppose you could add more traditional alternative assets like gold. I'm sure many of our viewers are well aware of the trajectory of gold recently, and as I said, it's not really the objective of FCIT to be multi-asset, but is it something that you think about from time to time for the trust, or and how do things like that influence your decision making?
Yeah, it's a really good question. So my just as a brief aside, my wider role is head of multi-assets in Columbia Threadneedle. We run as a team. There's more than 20 people in the team, and we run more than £60 billion worth of assets. So we do invest cross-asset outside of equities and private equities. So we do think about these issues. I would say that crypto is not an area which we have invested directly into the tokens. We do have some investments in the private market space in technologies and companies that are looking to benefit from the technologies that underpin some of the crypto thesis like blockchain. But we don't invest in crypto. We don't invest in gold. We do have some gold mining exposure, very small in F&C. Are we going to invest in those areas in terms of direct exposure to gold and crypto? No, it is not on the agenda. It just really sits outside, I think, the mandate that we have in terms of growth assets. Gold has done phenomenally well, and I'm well aware of not only the performance of that asset, but the factors that have driven it. And crypto, obviously, is certain crypto assets, Bitcoin in the longer run have done phenomenally well as well, and maybe viewed as digital gold by some. What I would say on both is, obviously, gold has got industrial applications, and one can think about cost of extraction against, current pricing. I find it quite difficult to value assets that don't have a series of cash flows attached to them, or do not have. As I said, gold may have an underpinning in terms of industrial use. Bitcoin, what one I think is simply taking a view that this is digital gold doesn't mean that it doesn't have a role to play. But I personally do find it a challenge to determine whether the appropriate fair value for Bitcoin is 100,000 or 80,000 or 20,000. So we avoid those assets for F&C, but certainly in terms of gold, we do have portfolios elsewhere that hold it. I do see the diversification and return merits, but pretty difficult to value fundamentally, I find.
Yeah, and as a global fund, you have a very broad remit, but there's a question about what you wouldn't invest in, and obviously you're not marketed as an ESG fund, but are there sectors, companies, countries that you won't invest in?
Yeah, so we there are certain areas we do not invest in. We do not invest in tobacco stocks. We do not invest in thermal coal, and we do have an objective to align the portfolio to net zero by 2050 or earlier, as I said, and that has implications in terms of the way that we do think about investment at the underlying portfolio level. I think, look, we've got a very big team in Columbia Threadneedle that look extensively at the use of capital, F&C shareholder capital, by companies that we invest in, to ensure that that we are good stewards of capital, and that the companies that we entrust our shareholders' capital to are doing the right thing. But we are not a responsible fund. We're not a sustainable fund, despite those earlier comments I made. And we do look to ensure that we're engaging effectively with corporates to understand their perspective on controversial issues. Well, it might be, maybe the use of social media, it might be environmental policies, it might be labour force policies, it might be more diversity in terms of gender or ethnicity. And we think that engagement actually with companies is the most effective way to affect change in general terms, rather than being prescriptive and excluding.
Thank you. And there's a really good question about looking at your top 10. I think it's right to say this is a look through, isn't it? This isn't
Yeah.
direct holdings. This is the consolidated portfolio. So how much of the question is kind of around these, as the questioner says, frothy AI bubble stocks. How much of that exposure is concentrated with a few managers? So how easy is it to kind of pivot away? And then if you kind of looked at the portfolio from a thematic perspective, how much exposure do you think you have to AI? I think that's probably quite a difficult question to answer, because I don't think there's a company in the world that hasn't got some AI related activity. But if you could do your best to answer that as well.
Yeah, okay. There's lots and lots of different threads to that, so I'll just throw some things out. And look, I think there's lots and lots of questions, and we will do our best to put out some points that we can then share to those that have called in and been kind enough to give their time, and also to submit questions to areas I'm not going to come into. I'll make a few points. One, how easy is it to essentially pivot away from AI stocks and those big tech stocks if that was our desire? It's very easy, right? Essentially, we just essentially reallocate capital across the strategies and move the portfolio. Do I think it's appropriate to do so? No, not at the present time. We are underweight the Mag 7 overall. We're actually slightly long Nvidia, but we're typically underweight, against the market index, the other big tech stocks. The question on how much exposure we have to AI, there's so many different ways to think and answer that question. I do apologise that it's not a pithy, simple percentage answer. I think the whole market's, the vast majority of the market is going to be impacted by AI in terms of their proximity to the technology theme, in terms of production of GPUs, in terms of providing energy to provide data centers, or the application of technology to improve their business, or perhaps other slow movers being disrupted by not being moving quickly enough. So my strong view actually is, I'm going to draw an analogy here, because I think there's some questions about an AI bubble. We're not complacent. Valuations are rich, expectations are high. There are some analogies with the late 1990s. Alan Greenspan, who was the chairman of the Federal Reserve, gave a speech in 1996, which was very, very famous, remains famous to this day, when he talked about irrational exuberance. And the market went on to far, far greater highs than when he gave that speech. The NASDAQ peaked in March 2020. The FTSE peaked in December 99. So exuberance was building in 96, and it was a long time before that particular bubble burst. He also made a speech, I think it's really important to know, about once in a generational productivity improvements accruing through technology. And he was right. In the early 2000s, after the stock market bubble burst, there was a period where US productivity really improved quite markedly. And people were right about what the internet was going to do in terms of the economic benefits. They just got too carried away in terms of stock valuations. My personal view is that we are some way off the levels of valuations that would be characterized with a peak in a bubble. Typically bubbles, real bubbles that burst, like Japan, like the dot-com bubble, deliver around an 80% loss for investors. It seems to me we're not at that point. I think that you also have to bear in mind that the Federal Reserve is easing policy, not tightening policy, as they were in 1999. You can debate whether they're throwing fuel in the fire or not, but I think that there is going to be a really significant impact in productivity terms from AI. That is going to lead to benefits to owners of capital, to corporates in aggregate. There's going to be a lot of winners and an awful lot of losers within the market. But overall, actually, it is a good thing for corporate margins. Not so good for labour, it has to be said. And there's this tricky balance between unemployment and what it means for corporate prospects. But there is, I think, a strongly positive case to be made in terms of where we are in terms of the implications of AI and overall economic outcome and the implications for the market. But there are pockets of speculation. Clearly, valuations are moving higher. We are not at the point, I believe, that it is right to step out of a high exposure to the US and indeed to technology stocks at the present time.
No market melt up yet.
I think there are preconditions for a bubble. If you look at classic bubble behavior, you need a strong thematic, which is a real underlying fundamental premise, which is likely to be delivered. And I think we have that. You have had really 25 years since the last bubble, and you tend to, it's pretty unusual behavior sometimes, but there do tend to be quite long gaps between bubbles, whether it's the dot-com bubble, Japan, the Nifty 50. You don't necessarily, I do have memory, I did live through the dot-com bubble, but you have market participants that have no experience now of bubbles, what it looks like, what it feels like. We've not got to the point whereby people are, choosing new metrics to justify valuations, whereas back in the dot-com period, it was about, users or eyeballs or different metrics and, the total addressable market that you were looking at. So I think there are preconditions for a bubble, actually, but I don't think we are there.
Yeah. We've actually pushed up against time, but I'm going to ask one quick last question, which is there was a question about gearing, and I believe gearing's a bit lower than average. So if you want to address that, but also do you want to talk just a little bit about how what are the triggers for you to adjust gearing up and down?
Yeah, so I think it's a fair observation. So just putting some numbers on it. So we've got £580 million worth of debt at par at present, very low interest rates. And that means that, when you look at the percentage of gearing with debt at par right now, it's below 10%. It's about 9% or thereabouts. However, maybe a bit under 9 actually. But if you look at debt, gearing with debt at fair value, it's closer to 4%. The reason being that we mark to market the fair value of debt, and because interest rates have risen, it pushes down the fair value of our debt, and that pushes down the effective impact of gearing on the portfolio. So it's fantastic that we took all that borrowing at 2.4%, but probably my best contribution that I'll ever make in terms of this trust, and perhaps the best trade of my career, borrowing at that kind of rate. But because it's repriced, gearing has fallen. Could it be higher? Look, with the benefit of hindsight, it would have been higher. Markets have performed better than we've expected. I think the way that we think about gearing is obviously prospective returns in terms of the assets that we invest in. Valuations are high, so all else being equal, that probably means that you should be a little bit less geared. Borrowing rates should also be considered. If I was to go and borrow today, our all-in borrowing rate, if I went out and borrowed, 30-year money, is going to be north of 6%. Is that attractive? It's not as attractive as 2.4, but it's the best I'm going to get. So higher borrowing rates, rich markets would imply that gearing should be a bit lower, perhaps, than average. But I think it is a fair point, fair challenge, frankly. Should we not have a bit more gearing? And it's something that we do actively consider. And it's something that we will look to manage. Our debt profile is changing through time. So we have some debt that's maturing in 2026. So we need to think about, what we're going to do in terms of refinancing that, how much to refinance, what that means for overall gearing levels. So the short answer to the question, rather the long answer I've given, is, yeah, we could do consider gearing actively, and we'll look at market opportunities and think about whether we want to push gearing up at the appropriate time.
Yeah, I guess your private equity exposure, I know private equity people hate it being pointed out there's more gearing in private equity, but there is, isn't there? And that gives you a little bit more equity gearing than another investment trust without that exposure.
Yeah, I think that is a fair point. There is gearing in listed equities in terms of the underlying corporates.
Yeah.
There is gearing in private equity as well, which does, on average, tend to be higher than unlisted. So one could argue that the effective gearing in economic terms is higher than that 4% that is implied. I think the other point is, if market interest rates decline, then our gearing levels will rise naturally. It's a bit complicated, but basically the value of our debt is going to change, so the gearing will go up naturally. So if rates drift downwards at the long end, as I expect they probably will, then that'll push up the gearing a bit from where we currently are.
Yeah,
that's been equal.
There's a whole 45-minute webinar on debt.
Well, I'm not sure anyone will want to call into that, but yeah, if there is interest, we could definitely do one.
Paul, thank you so much for a really interesting and timely presentation and for rounding off our event this week. And to everyone on the call, thank you so much for attending. As ever, do not underestimate the amount of time and effort that goes into producing Paul's manager's reports in his report and accounts, and all the other associated materials on the website. And of course, you can always visit Kepler Trust Intelligence as well if you want some other background. So Paul, thanks so much for your time, and thanks to everyone on the call. This is recorded and you can download the slides later as well. But until the next one, I wish everyone a great day.
Thank you very much. Thanks for calling in.